Hi everyone! Yesterday's dynamics on Wall Street have proved once again how stocks are vulnerable to Fed's monetary policy signals. On Wednesday, the regulator unveiled its minutes from the meeting held 3 weeks ago. However, even despite this, they had a huge impact on the equity market. Before the release of FOMC minutes, stocks were highly volatile, unable to pick up a trajectory. Yet, after the release of the minutes where the Fed clarified future plans for monetary policy and the fight against inflation, the three benchmark indices closed the session with gains. In today's Asian session, the Nikkei 225 and the S&P ASX 200 indices were also up amid optimism on Wall Street. US stock futures rose today as investors continued to assess the economic outlook and the possible threat of the recession. The Fed meeting minutes confirmed that the regulator is determined to take soaring consumer prices under control. It's now the main priority of the central bank. Market participants have been doubting the Fed's competence for a while, so the regulator needs to regain their trust by showing it is capable of reining in inflation. Investors are getting rid of risk assets mainly because of the fear of uncontrolled inflation. Today, stocks are trading in the green, so it appears the Fed managed to convince traders that it will eventually combat inflation. Risk appetite was somewhat moderate in the Asian trade. Market fears have eased, so the US dollar slightly rolled back from its highs. It's down today due to an increase in risk appetite. In addition, the US currency weakened following a fall in the US Treasury yields. As a reminder, the greenback has a direct correlation with bonds. However, analysts warn that the US dollar may face bearish pressure from time to time due to the risk of a recession in the US. Now, such risks are not relevant as the US stock market is growing. The US dollar jumped to a high of 2002 last night. In the short term, it's expected to climb higher amid high interest rates and rising commodity prices. Besides, the US is a net energy exporter, which is extremely bullish for the US currency. In the Asian session, the US dollar index, which measures the strength of the greenback against its main rivals, fell to 106.83, retreating from the overnight peak of 107.27. Today, it's likely to move in the downward channel of 106.77, 170.714. Growing energy prices are an extremely positive factor for the US currency, whereas for the yen as well as Japan economy it's rather unfavorable. The weak yen and the rising cost of imported commodities are slowing the recovery of the manufacturing sector, the labor market, and retail sales. In May, the index of coincident economic indicators in Japan declined to 95.5, the lowest level since October 2021. Market participants are also worried about a surge in new coronavirus cases following the government's decision to ease all restrictions in April. At the same time, the Bank of Japan stubbornly sticks to an ultra-loose monetary policy. The regulator states that inflation in the country is probably temporary, as it's fueled by soaring energy prices. Given the economic headwinds, the yen as a safe haven currency has no bullish drivers. The Japanese currency is extremely sensitive to changes in the US long-term government bond yields. After the overnight decline in US Treasuries from a high of 2.935% to 2.904%, the dollar-yen pair fell to 136.10. During the Asian session, it was consolidating in the range of 135.52 and 136.21. After bouncing from 137, a 24-year high at the end of last month, the pair has been trading above the 135 level for the past few sessions. Analysts assume that the price may approach 140 after breaking through 137. Meanwhile, the Australian economy seems to have completely recovered from the pandemic woes. Trade surplus jumped in May to 15.965 billion Australian dollars from 10.495 billion in April. Naturally, the Aussie benefited from upbeat economic reports. In the Asian session, the Australian and American dollar pair was trading within the daily range of 0.6765, 0.6834. After falling to a two-year low of 0.6761 yesterday, the pair was hovering around 0.6823. Nevertheless, in the short term, analysts are making bearish bets on the Australian dollar. The pair is expected to decline to 0.6461. Given growing concerns about the global recession and new coronavirus restrictions in China, demands for commodities may fall. That's all for now. Subscribe to our channel and keep close tabs on market developments. Feel free to leave comments down below. See you!